Being a long-term dividend growth investor with over 7 figures invested in long-term dividend-paying stocks and ETFs, and specifically over $500,000 invested in this one single portfolio, I'm going to explain to you why I'm considering selling every single holding throughout this portfolio and going all in on one of the new Yield Max ETFs, ticker symbol TSLY, which has a current distribution rate of almost 70%. Now, before you comment on how crazy this move is and how I shouldn't do this, know that I'm most likely not actually going to do this, as it goes against my longer term, more conservative, less risky investing approach. But in this video, we are going to go through exactly what the TSLY ETF is and how it generates so much income on a monthly basis. Then later on in the video, we're going to go over the exact math and see what my dividend income could look like if I was to choose to liquidate this entire portfolio and go all in on TSLY. Because you just never know what I might do in the future. Now make sure you stick around until the end of this video, because the math and the results are nothing short of shocking. But we're going to go through all this and more. Right after you, please drop a like in this video and subscribe for more future content like this. So first things first, right here on the screen, this is one of my actual long-term dividend growth portfolios that I've been working on and growing for a number of years. Now this portfolio is currently made up of positions like 1,000 shares of Apple, 878 shares of Realty Income, and so on and so forth. This portfolio is made up of various stocks and ETFs. And if we were to add everything together, this portfolio is worth just over $500,000, sitting as of today at $517,000. Now, because of all the hype that I've been seeing as of recently around the dividend investing community, talking about all these different Yield Max ETFs and how a lot of investors are going big into these ETFs and looking to generate a massive amount of dividend income on a monthly basis, with distribution rates of over 55%, 68%, 32%, and 39%. Even with a well-diversified dividend growth portfolio like I have right here, there's absolutely no way that I'm generating yields like that throughout my portfolio. To be specific, this portfolio I just showed you generates around $2,100 of income estimated on a monthly basis, with an average dividend yield across the entire portfolio of around 4.8%, which I'm pretty proud of. But again, all the recent hype about the Yield Max ETFs and the Tesla Option Income Strategy ETF in specific, it really has had me wondering what would happen if I were to liquidate this portfolio and go all in on this super high yielding ETF. Well, before we go over the exact math and see what that would look like, let's first dig a little bit deeper into this ETF for those that might not be as familiar with it and want to learn how it works. First things first, heading over to the YieldMax website where TSLY has all the information we're going to need. Wasting no time and opening up the YieldMax TSLY Tesla Option Income Strategy ETF prospectus. It says investment objective. The fund's primary investment objective is to seek current income. The fund's secondary investment objective is to seek exposure to share price of the common stock of Tesla, or TSLA, subject to a limit on potential investment gains. Now, as far as fees go with this ETF, it is going to be a pretty massive fee of 0.99%, but as you keep watching this video, you're going to understand exactly why. It then says principal investment strategies. The fund is an actively managed exchange-traded fund that seeks current income while maintaining the opportunity for exposure to share price, i.e. the price return, of the common stock of Tesla, or TSLA. Subject to a limit on potential investment gains, the fund will seek to employ its investment strategy as it relates to Tesla regardless of whether there are periods of adverse market, economic, or other conditions, and will not seek to take temporary defensive positions during such periods. So that's very important. No matter what happens in the market, TSLY is going to stick with the strategy and keep it moving regardless. Now, this is a very important part of this ETF, so listen closely. It says the fund uses a synthetic cover call strategy to provide income and exposure to the share price returns of Tesla, subject to a limit on potential investment gains as a result of the nature of option strategy it employs. The fund's options contract provide, number 1, exposure to the share price returns of Tesla, plus current income from the option premiums and a limit on the fund's participation in gains, if any, of the share price return of Tesla. So next, this is also important. Why invest in the fund? The fund seeks to participate in a portion of the gains experienced by Tesla, which a lot of everyday investors, including myself, are definitely interested into. The fund seeks to generate monthly income, which is not dependent on the price appreciation of Tesla. So because of the synthetic cover call strategy, Tesla doesn't necessarily need to move up in price for the fund to generate a lot of money for investors, which is also very appealing. It then says although the fund may not participate in gains at Tesla's stock price, the fund's portfolio is designed to generate income from it. It then says an investment in the fund is not an investment in Tesla. This is maybe the most important part that a lot of people are getting very confused about. The fund strategy will cap its potential gains if Tesla's share increases in value. And that's because of the cover call strategy. Now, the fund strategy is subject to potential losses if Tesla's shares decrease in value, which may not be offset by the income received by the fund. So this is no different than any other covered call strategy for the most part. If the underlying loses a massive amount of value, even though the covered call seller has a bit of downside protection and earned the premium, it doesn't necessarily mean that the whole strategy isn't going to lose value. Also very important, it says the fund does not invest directly into Tesla. Fund shareholders are not entitled to any Tesla dividends. It says as part of the fund synthetic covered call strategy, the fund will purchase and sell a combination of standardized, exchange traded and flexible exchange call and put option contracts that are based on the value of the price returns of Tesla. In general, an option contract gives the purchaser of the option contract the right to purchase for a call option or sell for a put option the underlying assets like shares of Tesla at a specific price known as a strike price. Now, the synthetic covered call strategy is what this ETF uses. So it says in seeking to achieve its investment objective, the fund will implement a synthetic covered call strategy using the standardized exchange traded and flex option strategy above. So a traditional covered call strategy is an investment strategy where an investor, the fund, sells a call option on the underlying security it owns, and that's something that I do throughout my portfolios on a regular basis. A synthetic covered call strategy, something I don't do, is similar to a traditional covered call strategy that an investor sells a call option that is based on the value of the underlying security. However, in a synthetic covered call strategy, the investor, the fund, does not own the underlying security, but instead synthetically replicates 100% of the price movements of the underlying security through the use of various investment instruments. So the fund synthetic covered call strategy consists of the following three elements, each of which is described in greater detail further below. So a synthetic long exposure to Tesla, which allows the fund to seek to participate in changes up or down in the price of Tesla stock. Then on top of that, a covered call writing, where Tesla call options are sold against the synthetic long option of the strategy, which allows the fund to generate income. And then on top of that, some of the fund is going to be US Treasuries, which are used for collateral for the options, which also generate income. So now that we're all on the same page, we all understand exactly what the TSLY ETF is, how it works, I think it's time that we go over the exact math of what would happen if we liquidated my $517,000 dividend growth portfolio that I've spent years and years working on and went all in on TSLY. Well, because TSLY is currently trading at $14.56 per share. If we took $517,000, which is around how much I would get if I liquidated everything in that portfolio, and divided it by the price of one share of TSLY, in theory, we could buy 35,508 shares of ticker symbol TSLY if we liquidated everything. Now, of course, ticker symbol TSLY offers a massive dividend yield, at least as far as the trailing 12 months. But the most recent dividend payout was 83 cents, and that was paid on August 3rd. So if we were to purchase around 35,508 shares of ticker symbol TSLY, and again, just going off of the previous data, 83 cents was paid as of last month per share of TSLY. We would now, in theory, have a portfolio that's paying us $29,471 on a monthly basis. Now, I know what you're probably saying, even though TSLY paid out 83 cents last month, and that would generate us around $30,000 per month in dividends, we can't necessarily expect that every single month. And because of the nature of this ETF and because of the strategy, you're 100% correct. On top of that, when it comes to this style of ETF, from what I've seen in the past, there are going to be some other issues like share decay. If you look at the max time frame on TSLY, since it started, which is just around a year ago, this ETF is already down 33.8% just as far as ETF price. So even though in theory, if we bought TSLY with all of our portfolio's money last month, we would have generated around $30,000. There's always still other risks ahead, and we can't just necessarily think that this ETF is going to be perfect moving forward. And although I don't necessarily think that TSLY is a yield trap, there have been other really high yielding ETFs like the SDIV Global Super Dividend ETF, which has been around for many years now. This ETF offers a huge starting yield, but as you can see, investors that got into this ETF early are down almost 70% as far as ETF price. On top of that, looking at the dividends that have been paid out since the start of this ETF, you can see they pretty much for the most part have gotten smaller and smaller. So the reality is, to know what the future holds for the yield max ETFs and TSLY specifically, it's going to take time because there's just not all that much historical data to go off of. But either way, that being said, I'm definitely going to be buying a few shares of the yield max ETFs to play along with everyone else buying into this ETF and to see how it performs later on. But I want to hear from you guys down below in the topic of selling my entire portfolio made up of various dividend stocks and dividend ETFs. Do you personally think I should sell off my entire portfolio and go all in on TSLY just for an experiment? Comment down below yes or no. If you enjoyed this video and you want to see more videos like this in the future, make sure to please drop a like down below and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.